Welcome to Once Upon a Coin, documenting the ongoing history of blockchain and cryptocurrency. And as always, I'm your storyteller, Jason Cassidy. Today's story is in continuation of our series looking at the history of crypto year by year, from the past all the way up to the present. They say to know where you want to go in the future, you first have to know where you came from in the past. And does that ever hold true here? We're about to take a look at what is quite possibly the craziest 12 months that the cryptosphere has ever experienced. And it's not for the faint of heart, so remember, I warned you. This is a story of crypto in 2016.
Sun cast a shadow, a digital line is coming over the mountain and over your mind. Go down your Bitcoin, hang on for the ride. We're moving into the future, one block at a time. We're moving into the future, one block at a time.
If you lived through the industry back then, you know exactly what I mean about this year being a very tough one. It's a year that a lot of cryptonauts tapped out, whether from mental exhaustion or simply running out of coinage to sustain themselves, when you're factoring in that we were about to go into the third consecutive year of a nasty bear market. Not since late 2013 had the market experienced anything remotely positive when it came to the price of Bitcoin or the legions of altcoins that were now forming around Bitcoin's base. Thankfully, the end of 2015 brought us a small glimmer of hope that things would turn around for Bitcoin when it finally broke out of its low trading range, and it actually managed to get up into the $400 price point in January of 2016. This welcome reprieve from the bargain basement prices that Bitcoin had been stuck at was met with some positive news. On January 14th, the Lightning Network, a layer 2 solution meant to help Bitcoin scale, was released. From here on out, the Lightning Network became a bigger and bigger point of focus for Bitcoin, as its 1 megabyte block size limit required additional support to make the network more robust. Just 1 week later, a new entrant into the cryptocurrency scene showed up, and this one was all about privacy. Zcash was announced on January 20th, launching its alpha release and sending a clear message that while Bitcoin was great, it wasn't nearly anonymous enough for some users. For those that wanted to transact in a private nature, there was now a solution outside of Monero. Zcash would go on to become a household name in the industry for this exact reason, its strong privacy features. Before the end of the month, more institutional news broke when the Bank of England announced that they were looking at using DLT, or distributed ledger technology, for settlements. Little did anyone know at the time, but this news would actually be the first in a long stream of central bank announcements endorsing blockchain technology. February saw the price of Bitcoin more or less maintain its orbit in the $400 USD range, but in March, some interesting developments took place. Ethereum had launched last year with its Frontier release, and now it was time to bring the next major update to its blockchain. This came in the form of Homestead, which rolled out on March 14th. This release introduced 3 major changes, with arguably the most important being the Mist wallet. With the Mist wallet, users could now store their Ether in a non-custodial fashion, while developers could both now write and deploy smart contracts. Having the benefit of hindsight and looking back now, we can clearly see that these upgrades to Ethereum were actually helping it prepare to go right to the stratosphere in the not-so-distant future. Now, as for its immediate impact, well, the price of Ether jumped up and broke through the double-digit barrier for the first time in its history, hitting $13 US in March. For context, Ether was sitting at the $1 USD mark for seemingly ever. So if you were bullish on Ethereum but you missed out on the ICO, you are now looking at a pretty sweet return if you were accumulating up until this point. Also in March, China, known for its long-term planning, continued this trend when it released its 13th 5-year plan that would span from 2016 to 2020. While these 5-year plans aren't anything new from the Chinese government, what was curious here is how big of a role that cryptocurrency and blockchain played in that plan. It was yet another affirmation that while the industry was suffering from a prolonged bear market, big businesses and major governments were looking at the bigger picture and seeing the future of blockchain technology. The start of the year saw some positive price movement for both Bitcoin and Ethereum. A new crypto entered the scene in Zcash, and Bitcoin was getting some scaling help with the Lightning Network. And of course, I'm recapping here because What comes next is pretty brutal. The world was about to get introduced to the concept of a DAO, or a decentralized autonomous organization. Now, if you're wondering what the hell I just said, a DAO is basically a group or organization of people that work together without a formal company structure in place, thus the decentralized part. In theory, everyone has a say and contributes to help making key decisions about how the organization should move forward. A DAO basically distributes decision-making, management, and equity ownership amongst its stakeholders. Stakeholders are defined as token holders, so if you own some of the token, then you are by default part of that DAO and thus its governance structure. This all sounds really, really good, at least in theory. This is exactly what was rolled out in April, when the offering that was simply known as the DAO was made available via an ICO or initial coin offering. The DAO was built on the Ethereum network and would function as an investor-directed venture capital fund to help spur innovation and adoption within the Ethereum ecosystem. The sale lasted for 28 days and raised over $150 million in Ether at the time, making it a resounding success. Keep in mind that at the time of the sale in April, Ether was valued at around $8 US a coin. So that is a lot of Ether raised here. People loved the idea behind the DAO, and thus they wanted to get their hands on as many DAO tokens as possible. Just as the hype from the red-hot DAO sale was beginning to ramp down, on May 2nd, the Satoshi Nakamoto mystery was revived. Craig Stephen Wright made a public declaration that he was indeed the inventor behind the revolutionary payment technology the world now knew as Bitcoin. Wright's claim was met with severe criticism, leading him to enlist the help of the Bitcoin Foundation's founding director John Matonis and lead Bitcoin developer Gavin Andresen. Both men vouched for Wright's claim as being the real deal, however this too was met with skepticism. This confidence that Wright was indeed Satoshi stemmed from a now infamous signing session in which Wright met up with Andresen in a hotel room and signed a message from Block 1 on the Bitcoin blockchain. It worked, with Andresen seeing it happen with his own eyes, while overseeing the process to ensure that a clean USB stick, new laptop, and Electrum software was used in the demonstration. The reactions to this event range from people believing that both Matonis and Andresen had been tricked by Craig Wright, to others believing that both men were part of an evil plot with Wright to try and hoodwink the world into believing that he was Satoshi. Seeing the mostly negative reactions to this, Wright decided to end his quest, at least at the time, to gain recognition for being Satoshi and declined to provide any further evidence to support his claim. It's worth noting that there is a lot of doubt cast around the validity of the Block 1 signing event. So much so that Andresen has updated his stance, saying he regrets taking part in the event entirely. This controversy increased both the stakes and the intrigue revolving around the mystery of who is Satoshi Nakamoto. One reason that so many people are fascinated by this drama is the potential implications for the entire crypto industry. You see, there is a well-known 1 million Bitcoin Satoshi wallet floating out there on the blockchain. These were early Bitcoins that were mined by Satoshi himself and put into a wallet that hasn't been touched in a very, very long time. If and when Satoshi returns, be it Craig Wright or someone else, the idea of a single entity controlling 1 million of the total 21 million Bitcoins to ever exist is downright scary. There isn't consensus around exactly how many coins Satoshi controls in his wallet due to so many addresses having non-trivial amounts of Bitcoin attached to them. But the one thing we do know for sure is, regardless of how many coins it is a lot. And if those coins were to come to market in a surprise unannounced sale, watch out. While the month of June provided a much needed reprieve from the Satoshi drama, it did bring along with it something much, much worse. On June 17th, the DAO was fatally hacked, triggering a shitstorm in crypto that is truly for the ages. A bug was found in the smart contract that controlled the DAO's ICO funds, allowing the hacker to drain the wallet of its Ether. The interesting aspect about blockchain tech is that in this case, it allowed the victims to watch the heist happen in real time via block explorers. What a surreal situation. The attacker managed to extract 3.6 million Ether. Not dollars, Ether. The sum was worth $150 million US at the time, if you're wondering. There was one saving grace. Although the hacker obviously withdrew the Ether, he had to withdraw it into a child DAO. This child DAO had all the same characteristics as the parent DAO, which had an enforced holding period of 28 days for all funds. This entire fiasco went over about as well as Drag Queen Story Hour, so yeah, pretty bad. Some people felt the hack was highly unethical, but technically valid because it didn't break any of the DAO's hard-coded rules. But others, specifically those invested into the DAO, were out for blood. They wanted their money back, and they wanted it back now. Of course, the only way to accomplish this and ensure that the funds were protected would be to do what many thought to be the unthinkable: hard fork the Ethereum blockchain to a time before the hack took place. This meant that a brand new version of Ethereum would be created out of thin air, while the current and now reputationally damaged version of Ethereum would be left to its own fate. This was a highly contested plan because it clearly breaks the ethos of decentralization. Imagine if every time someone on a network with millions of users experienced a financial loss, you tried to fix that by hard forking the blockchain and creating a brand new one. Obviously, this wouldn't be feasible and people would leave in droves. But this wasn't some random crypto nod or even an exchange that had got hacked. This was arguably Ethereum's biggest and brightest invention yet, with some of the highest rollers in crypto having invested into it. And big names tend to have even bigger influence. And so, in the end, the decision was made to hard fork the Ethereum blockchain and make a new copy of it. The existing and originally hacked version of Ethereum was rebranded to Ethereum Classic, or ETC as it's known by its ticker symbol, and it's still in operation today. The new, freshly forked version of Ethereum actually took the name of just Ethereum. This was done so that people that were introduced to Ethereum after this event took place would think they were using the original Ethereum blockchain, even though they were not. This situation caused so much pain, suffering, and confusion for the entire industry that the DAO was basically shut down and looked at as a failed idea. And despite the hard fork, it still caused lingering problems because the hack that took place on the original and now rebranded Ethereum Classic blockchain still had to be resolved somehow. By forking the network, the problem of the hack was now isolated to a version of Ethereum that most of the crypto world was no longer using. And thus the token lost value, with most of that value leaving the Ethereum Classic blockchain and going over to the new created version of Ethereum and its token. But because the Ethereum Classic version of the network's blockchain token still had some value, it did cause misery for the entire half of 2016 and basically left a permanent scar on the industry afterwards. As you can imagine, the price of Ether suffered from this, starting out at $19 at the beginning of the day when the hack happened and cutting in half down to $10 where it stayed for the rest of the year. Suffice to say, June was one wild ride in the blockchain world. So it was a welcome break when July finally came around because it was relatively quiet. But something did happen here. It's just that most people wouldn't come to recognize its significance just yet. Consensus, the blockchain development company whose focus was on making Ethereum the most utility-driven network in the world, released the Metamask wallet as a browser extension. Metamask would go on to become the most popular wallet in the entire Ethereum ecosystem, hitting the 30 million monthly active user milestone in March of 2022. That little factoid helps underscore how important this release was back in the chaotic summer of 2016. And just as the industry was recovering from the nasty DAO hack, it got hit with a true knockout punch. And that's because in August, it was the OG exchange Bitfinex that was making headlines for all the wrong reasons. Hackers were able to exploit a bug in the multi-sig system through Bitfinex's partner, BitGo. The thieves were able to fool BitGo's algorithm, which allowed them to withdraw roughly 120,000 Bitcoins from the exchange's hot wallet. Unlike many exchange hacks, which leave customers without any recourse for compensation, Bitfinex's situation played out differently. They spread the losses out between all users by freezing 36% of funds in each wallet. This was then compensated by issuing their own exchange token called BFX. The tokens could then be redeemed for US dollars at a set rate, or the users could opt in to take shares in the parent company, Bitfinex. Doing this likely helped the exchange survive such a serious hack because the value of the Bitcoin stolen at the time was worth north of 72 million US dollars. While all this was happening, Bitcoin, which didn't have the issue of its blockchain being run through the mud like Ethereum, was chugging along nicely. The price had moved up and was now trading in the $500 to $700 USD range. Things were beginning to look up for Bitcoiners who had now suffered through 3 consecutive years of a brutal bear market. In a year that had a lot of calamity, the biggest event to close out 2016 centered around Bitcoin and the scaling debate. And while it wouldn't come to a head just yet, things were ramped up a notch when on October 27th, Bitcoin Core 0.13.1 was released, introducing the segregated witness update. And while this update would help the network scale, it was also a sign that smaller blocks were becoming a more palatable option on Bitcoin. And as you will learn in future episodes, the block size debate became so heated it eventually led to a full-blown Bitcoin civil war. And speaking of Bitcoin, it ended the year above $900 US a coin, signaling to the industry that sentiment had clearly changed and shifted towards the digital asset. Something magical was about to happen, something that would be very difficult to put into words. And guess what? We're going to be looking at what made 2017 so special in the next episode, so be sure to check out the story of crypto in 2017. I hope you enjoyed today's stroll down memory lane. Until next time, have fun and enjoy life, my friends. I'll be back soon with another incredible story to tell you.